Welcome to part 3 of the free course series. I'm QC Lee, the founder of the Motivated Trading Company. Now, in the last video, you got an introduction to options trading. Now, in this video, I'm gonna give you the full picture and wrap everything up for you. This information will be crucial. And if you can get through this, you have what it takes to succeed. Now, without further ado, let us begin.
Yo, QC Lee here, back and better with some more game for you future millionaires. Now, in the last video, we explained options 101. You guys got a quick and good intro to options trading, and I hope you understand the power of it a bit. Now, in this video, I'm gonna go through and explain everything else that you need to know about options trading. Now, stay with me, it's gonna be good. By the end of this video, you're gonna have a great understanding of options trading. Now, without further ado, let's go ahead and get into these concepts, baby. Now, in the money, out of the money, at the money. What do these things mean, okay? And how do we use them? Let's get into it. Now, in the money means that the strike has already been reached. An example of this, remember I gave y'all that Apple call example? See, if you picked a strike, say you buy the Apple 200 call, okay? And then Apple goes up to 205. Then your strike 200 would be in the money, okay? 200, 201, 202, 203, 204, all of those would be in the money because the strike has already been reached. And for puts, it would be vice versa, which I'll just explain. For puts, you're just gonna switch that around. Now, at the money would technically be 205. Since Apple's at 205, at the money would be 205. Now, out of the money means that the strike has not been reached yet. So say you bought an Apple 210 call, but Apple was only at 205 at the stock price currently. Your option contract with your strike that you picked, since you picked 210 instead of 205 or something below it, that would be considered out of the money, okay? At the money is basically, for this example, it would be 205. At the money just means it's equal to the stock price or very much near the stock price, which we'll get into later. Now, I know that sounded confusing. I know that sounded a little bit like mumbo jumbo, different language to you, maybe if you haven't heard it before, but it's all gonna make sense. It's not as bad as you think, and I promise, when you're trading this stuff, especially with us, we're gonna guide you through it, and it's not gonna be as hard as this stuff seems. Trust me. Now, let's continue. All right, remember I gave you guys an example? Let's give you guys another one. All right, now Apple's at 200, okay? Instead of 205, let's just imagine 200 for this example here. Now, this is something called an option chain, okay? Which I'll show you guys an official option chain on the brokerage called Webull, which I'm gonna show you exactly how to set up step by step in the next few videos. So stay tuned for that. Go ahead and watch that to make sure. Now, the strike price, we see 190, 195, 200, 205, and 210. Okay, this is a little like representation of what an option chain might look like. An option chain is just where you're gonna see all the options that are available to trade. Okay, now calls. All right, here's some calls right here. The calls, if Apple's at 200, remember, what does this mean? In the money. It means that the stock price has already been reached. It's already been touched, okay? So Apple's at 200, so the 190 call is in the money. Now, the 195 call is in the money too because it's already been reached. Apple's at 200. They already passed 195. It already passed 190, so it's been reached. Now, 200 at the money, okay? Technically at the money. Now, we're gonna see how at the money works. It's kind of a general term, but for now, focus on this. 205, if I chose the 205 call to get, that means I'm out of the money. Okay, 210, I'm out of the money. All right, now for puts, switch it around. Remember, betting on calls is you're betting it's gonna go up. Betting on puts means you're betting it's gonna go down. If you want it to go up, get calls. If you want it to go down, get puts. Okay, so it's gonna be switched around. Now, if I want Apple to go down, I'm gonna get puts. Now, if I get 205 puts, then this has already been reached, okay? I want it to go down, okay? I want it to go down. So 195 is what I want it to go to, and 190 and below. If it's at 200, I want it to go down. Okay, this stuff has already been reached, all right? It was already there at one point, or maybe not, but I want it to go the other way, all right? Out of the money, 195, 190. It's at 200. So it hasn't reached there yet. It hasn't gone down those 5 points yet. It hasn't gone down those 10 points yet, okay? So it might seem confusing, but just switch them around for calls and for puts. And when you switch it on your option chain, it'll switch around too. Sounds confusing. I promise it's all gonna come together real soon on what in the money, out of the money, the benefits, on what we trade. I'm gonna tell you all that stuff. So stay tuned. I'm gonna tell you what I trade to. Now, take a little screenshot of this if you like, but just understand the concept of out of the money, it hasn't been reached yet. okay? That price has not been reached yet for the stock in the desired direction you want it to go in. In the money, it's already been reached. At the money, it means that the strike is equivalent to the stock price or just about near it. Just remember that, get that down, get that into your head. Don't overcomplicate it. Let's continue. Differences and benefits. Okay, now out of the money is less expensive and slightly more risky. Why? Maybe you can figure it out from the things that I've told you already, but that's why I'm here to figure it out for you. Now, out of the money is a little bit more risky because the stock price has not been reached yet, okay? Now, the stock price hasn't been reached yet, so remember when I told you about exercising? Something, again, we don't exercise, but I'm explaining the concepts of why they're priced the way they are and why it's less expensive, because it's a little bit more risky because we don't exercise. Now, when I told you, when you exercise your option contract, you exercise your right to buy or sell those 100 shares at the strike price, okay? So if Apple's at 205, let me draw a little example. Apple's at 205, that's 205 on the very top here, and I buy a 210 call, okay? But it's only at 205. So here's 205. Okay, yeah, just act like I'm good at drawing. 205. Apple's at 205, and then I get a 210 call, okay? Now, that's gonna be not as expensive as if I got the 200 call. Because if I exercise my right to buy those 200 shares, or those 100 shares, let me be clear, those 100 shares at 200, I could make profit instantly. Okay, but if I exercise my right to get it up here at 210, which is not there yet, I don't make profit instantly. Okay, now that's just with exercising. All right, now we don't exercise our right because we void our premium leverage. All right, out of the money. Okay, less expensive, slightly more risky. Okay, I just explained that. Now, in the money, it's gonna be more expensive, slightly less risky. Why? Because the price has already been reached. So if I were to exercise my rights to buy those, 100 underlying shares, I would already be in profit. Okay, so that's why these are more expensive, because you're taking a little bit less risk. Okay, now at the money is the sweet spot. Okay, it's a fairly equal balance of both of them, so they're going to be in the middle of the price and in the middle of the risk. Now I'm about to tell you what I trade and what we trade as a group. Me and the other pro traders in the group, we have a bunch of analysts who will also trade with us that you'll get access to. Now here is what we trade. Okay, let's explain. Now, what should you trade? Okay, I told you I was going to show you an option chain. Here it is. Here's an options chain. There's the bid, the ask, the last price, percent change. Don't worry about all that stuff right now, but focus on the strike right here. This is Apple. Apple is at 188.6 right now. Okay, I trade 1 to 3 strikes out of the money most of the time. Okay, I basically trade at the money as much as possible. All right, remember I said at the money basically means it's near the stock price. So you see what these red lines are? That's where I trade. All right, 1 to 3 strikes out of the money, but anything in here is usually good to trade. Okay, that's what we trade. That's what you want to focus on. All right, I trade 1 to 3 strikes out of the money. Here's why we do that. Okay, the goal when you trade options, you want to go from out of the money to in the money. Okay, the price, the premium, okay, the price, this is the price right here that you'll pay times 100. Now let's go ahead and just clarify that real quick. All right, so this option is for 0.25. That means it's $25. Remember, leveraged off of 100, okay? This one's for 0.54, all right? $54, okay? This one's for 1.18, 118 bucks to get in for one. And there's a lot of pricing here. And this one is for a 30-day call, and they get cheaper as the expiration date gets shorter. So, all options are not going to be this expensive. Don't worry if you only have $50 to $100 to trade. As long as you have $100 to trade with, you can definitely trade with us and make money. We have plenty of clients who make plenty of money, which I'll even show you guys. I'll probably put some stuff on the screen or something to show you that. We have plenty of clients that make money who have $100 to a few $100, even less sometimes. So anyway, that's the premium. This is the price, the mid price. All right, that's the premium that you'll pay to get in for one. Again, let's go back to why we want to trade 1 to 3 strikes out of the money to make the most money. You want to go from out of the money to in the money. Okay, the premium, the price right here, is going to move faster and more accelerated during this phase. Okay, from the phase of it going from out of the money to in the money is when you're going to make most money. That's when the premium is going to jump the most. Okay, that is why we trade that, okay? Now, if I want to take a little bit less risk, and if you want to take a little bit less risk too, remember I told you, you can play in the money, okay? If you choose the wrong direction and you play in the money, you'll lose a little bit less than if you chose out of the money, okay? But I don't play in the money nearly as much. I play 1 to 3 strikes out of the money, and most of the time, I'm really playing right here, like 1 strike out of the money. That's really what I play the majority of the time. So I hope you guys understand that, and I hope you understand which ones you should trade, and I hope you understand why, okay? So if you have a question, if I'm doing good, give me a like, give me a subscribe. If you've got a question, drop it in the comment right now. Shoot me a DM on Instagram. I'll go ahead and tag it in the description. Now let's continue. We got some more sauce for y'all. Let's get it. All right, option Greeks. Now, before I get into this, I'm gonna warn you, fair warning, it's gonna sound a little bit confusing, okay? But it's not. All right, this stuff is not as confusing as you think, and you don't have to pay attention to all of these, okay? In fact, if you trade with us, you don't got to pay attention to these at all at first, because we're going to tell you which contracts to get in and when they get in, when they get out, and how to do it, okay? But that's only if you choose to trade with us. Anyway, let's go through these, but I don't want you guys to overcomplicate these in your head and think you have to just pay attention to these at all times and stuff like that, okay? You don't. I'm just going to explain these for you real quick. You know, jot them down, take some notes, pause, get a drink, chill out. I got you. All right, let's get into it. The delta is going to be the rate of change of the option premium price. The price is the premium, okay, per $1 move of the underlying stock. Basically, this tracks how fast is my option premium going to move when the underlying stock moves, all right? So if Apple goes up $1, this tracks mathematically how much is my contract going to move up when Apple moves up $1 if I pick calls. That's it. Very simple. Just think of it like that. Now, theta, this is time decay on your contract, okay? This will increase the closer you get to expiration. So as you get to expiration and you continue to hold for this, okay, it is gonna start eating off more and more and more and more and more and more and more of your contract. Now, this should not affect you. Us, whenever we trade, theta does not affect us, especially if you pick the right direction within the right time, which is not as hard as it, as some people will try and make it out to be. Theta, time decay, will not affect you. The delta and the movement of the underlying stock will heavily outweigh your theta if you're doing it correctly, and we do. So theta does not affect us, okay? So theta is something you should look for when you're going in long, or if you're playing like same day expiration contracts, which is also not advised if you don't know what you're doing. But if you have a mentor, if you have some guidance, then okay, cool. But if not, I would stay away from 0 DTE, meaning 0 days till expiration, okay? Like I said, the time decay will increase the closer you get to expiration. So if you're playing an option contract that expires in 6 hours, the theta is going to be pretty hefty on that, okay? But if you choose the right direction, if you're doing it right, theta should not affect you. Now, gamma tracks how fast delta will change as the stock moves. Remember, I just told you that the premium, you will make the most money on options when it goes from out of the money to what? In the money. Yes, I got it. Let's just act like that you said it too. All right. Now, this is going to track how fast the delta will change as the stock moves. So your delta, okay, it's going to rise as you go from out of the money to in the money, okay? As you choose the right direction and the stock moves, your delta is going to go up, okay? You choose the right direction, you'll start making more and more and more and more and more and more money as the stock is rising, okay? And that's one of the good things, again, about options. If you do it right, you can really come out with some really good profits if you manage your risk right and do the right things, which I'll get into how to manage risk in another video. Stay tuned. Now, okay, that's how it tracks, okay? So gamma tracks how fast the delta will change as the stock moves, and the delta tracks how fast your option premium changes as the stock moves. A little bit confusing, but gamma is not really something that you're going to be too focused on or anything like that. Neither is Vega, to be honest. But I'm explaining it to you anyway, so you got that knowledge anyway. Now, Vega, the rate of change of the option price premium, once again, for 1% change in implied volatility. What is implied volatility? It's exactly what it sounds like, okay? Implied volatility is literally how much the market thinks and expects that option contract to move. Okay, so if implied volatility is 200%, the market expects that contract to be very, very, very volatile. Okay, now Vega is going to track how much the premium is going to change per 1% change in implied volatility. volatility. Now, that sounds complicated, but it's not something that you will generally need to worry about unless you want to play earnings, or if you're playing crazy movements, which when you start out, you shouldn't be doing this anyway. Then you have to look at this and you just want to make sure that you don't get something called IV crushed, which is when you say you want to play some earnings, okay? And you pick the right direction. But once you wake up the next day, the implied volatility goes from 300% to 20%. That's going to destroy your contract, okay? That rarely happens, but I just wanted to throw that in there so you guys understand. All right, don't worry about that stuff. Just wanted to tell you it. I don't want to overload you with information, but here's the next things that I'm going to tell you to focus on. All right, now, which should you use? To start, I want you to only pay attention to theta and delta. I want you to avoid large theta contracts at all costs, okay? Especially if you don't know what you're doing, all right? If you have no guidance, you have no mentor, if you're not in a Discord group, if you don't have anyone, if you don't have a community, you don't have guidance, avoid large theta at all costs, man. Avoid it. Run, man, run from large theta. Okay, this is always going to be a negative number. So by large theta, I mean like negative 0.86, negative 0.6. You know, the closer to zero, the better. The smaller the negative number, the worse. So like negative 2.6, negative 1, avoid those. Avoid large theta, okay? And you can see it on your option chain, which I will go into in a different video. Now, look for a higher delta. Okay, you want to look for a higher delta in contracts. Now, contracts that are in the money will always have a higher delta. On the next slide, I'll give y'all 5 stocks that are good to start out with for trading. So stay tuned. Anyway, look for higher delta. And for puts, this is going to be a negative number because it's going down. All right. So you want to apply those same principles to that. But again, what I want you to take from this slide, if you don't know what you're doing, if you don't have guidance, you don't have a mentor, run from large theta, which is a negative number. Okay. Run from those large negative numbers and look for higher delta if you can. All right. That's it. Let's move on. Some more terminology for you guys. This is some important stuff, but again, if you do it right, don't gotta worry about a lot of this stuff, man. This all comes down to it. If you do it right, especially if you do it right the first time, you don't really have to worry about a lot of this stuff, all right? Now, open interest and option volume. Okay, open interest is the number of open, by open, I mean people who are owning those contracts, of open options contracts in the market currently at any time. So usually when you see this number, it only gets updated once per day, like usually at like market open. So once you see this, this means the open interest is the number of option contracts that are being held, that are being opened. So you scroll over and you see the open interest is 20,000. That doesn't mean there's 20,000 people that are holding one contract. That just means there's 20,000 contracts being held. Now, volume is the number of options contracts traded during a certain time, usually within a day. Now, why is it important? Because you need liquidity. Remember, I explained liquidity in the last video, all right? So if you didn't see it, go ahead and watch it. You need liquidity. Liquidity is basically how easily can I get in this asset and how easily can I get back out and convert it to cash. Now, if you don't have liquidity, say you get in it, but you can't get out it, it's not good. Now, you don't have to worry about this. Once again, you don't got to worry about it when trading blue chip stocks, okay? NVIDIA, AMD, SPY, Tesla, Amazon, okay? Those are some good blue chip stocks. They have lots of volume, lots of open interest. You will rarely ever have to worry about any type of lack of volume or lack of open interest on those 5 stocks. That's it. This was by far the most complicated part, okay? This was the most conceptual and complicated part. So if you got through this, you are a G. Pat yourself on the back because you did this. Congratulations. Cheers to you, okay? Now, LFG. This is the last lesson, okay? LFG in the trading community means let's freaking go. That's what it means, okay? So let's freaking go, baby. You did it. Congratulations. You got through the hardest part of this. So this tells me if you got through this, you got to the end, you can, bro, the rest of this course is going to be a breeze. Like, you got this. Like, you are going to be a millionaire. So I will see you in the next video, future millionaire. This was QC Lee. I'm out.